All right. Well, here we are.
Welcome. This
Welcome.
is, we're trying our first podcast, or not even a podcast,
Video
is it? Our new
podcast.
video, trying to get into the 20th century. Thank you, Dave.
Yeah.
So for those of you who don't know us, I'm Laurie Littman. This is Dave Baldwin. We're with LS Investment Management. Just a quick background. It was started by my father. I work with my sister Beth. We brought Dave in. We've known him since 2004. We have two offices, one in La Mesa and one in Vista.
I first started with Laurie and Beth. Since made a couple of changes. I was actually, for a long time, I had a role as sort of an outside salesperson with an institutional asset manager, which was a really neat experience, and got to, go out and talk to a bunch of people, clients, other financial professionals, about what's going on in the market, and then went back into being a financial advisor, and then recently was able to partner back up with Laurie and Beth, and so the purpose of this, I think, we get to show, we have these conversations all the time, and now kind of showing folks what those conversations look like a little bit behind the scenes, maybe.
Yeah, a glimpse into what happens in our office on a daily, weekly basis.
Yeah, and so we're going to talk about what happened over the last quarter, kind of what's happening now in the market, and just some thoughts, kind of what we're looking at, and maybe reasons why. I do have to say this information is general in nature. It's not intended as specific investment advice. It's only after we can meet with a client, understand what it is that they're trying to accomplish, what their investment objectives are, their comfort level with risk. We have to understand all that before we can make a suitable recommendation. So again, this discussion is really just
kind of a high-level look at what we think is going on in the markets.
Yeah, what happened in the third quarter?
I think on everybody's mind is inflation.
Absolutely, yeah.
Is it here to stay? Is it transitory? What are your thoughts, Dave?
I definitely don't think it's transitory. I think it's here to stay. We saw, as an example, right, the Dollar Tree is no longer $1; it's $1.25. They don't go back from that. We saw energy prices probably lead a lot of that inflationary pressure. But if you're a business that has had to adjust your prices and maintain your margins, even though all of your input costs have gone up, I mean, you're not giving back that territory that you gain. Once you can implement a price increase, you're not going back. So I don't think that the inflation is transitory. I think it's pretty permanent. In the third quarter, as far as news, we saw really the beginning of what should have probably been called a recession. I don't know why, they didn't officially call it that.
We're hearing both. Some people say it is. Some people say we're not there yet. We might be there. We're not there.
Yeah, and the definition would be 2 consecutive quarters of negative GDP. So the first quarter, we were down 1.6%. The second quarter, we were negative 0.6%. Now that's not that much, but it's still negative, right? And so the resistance to call it a recession, I think, maybe stems from the fact that employment is still pretty good. We have low unemployment.
Right.
There's kind of the joke, if your neighbor loses their job, that's a recession. If you lose your job, that's a depression. And what do you call it if nobody loses a job? Nobody lost their job.
Yeah.
Right? So that's a positive thing, right? We're glad that we're not seeing big unemployment numbers, but that might be, we haven't seen that yet.
Correct.
Right?
Correct.
So the other big news, the Fed raised rates.
Fed raised rates. When did the Fed start raising rates from zero from last year?
So we started the year off at 0 to 25, somewhere in that range, right?
Mm-hmm.
And then in March, we went up 0.25%. In May, they went up 0.5%. And then in, June, July, and September, each of those were each 0.75%. So that put us now, do some quick math, 3 to 3.25.
Okay.
And it's still going up.
They still said, I believe in their last Fed report, their meeting, that they were going to continue to raise rates based on what the market is doing and as long as inflation is still showing.
Yeah, yeah. And I don't think that inflation, so it peaked in June at 9% and it came down to 8. But that's still, I mean, normally we've been living in this sort of 2% inflation range.
Right.
So obviously this is pretty elevated.
Right.
What does that mean for stocks? How did stocks respond in the third quarter?
Well, apparently consumers are still willing to spend.
Yes.
And that's what's partially keeping prices high. But we're just getting the stock reports for third quarter. We've been getting them this whole week.
The earnings, yeah.
The earnings, and I think the majority have been quite good.
Yeah, and I think that stock prices follow earnings. So if earnings are strong, the stock will continue to appreciate. It's when earnings don't meet expectations that people feel like, hey, I don't want to invest in this company because they're not able to make those earnings. So it's a positive sign going forward that we continue to see them meet or even beat expectations. But what we kind of went through in the third quarter was, a lot of fear that because of the rising interest rates, because of inflation, that consumers wouldn't go out and spend as much money, and that led to quite a bit of volatility within the market. One thing, kind of that consumer's willingness to spend.
Mm-hmm.
I wrote about this a little bit in my book, The Balancing Act, and you have almost an adjustment that gets made. You kind of get this new lifestyle or this new income, and then you spend and you get very comfortable with that level. So you adapt. And one thing that I think over the last 2 years, we saw consumers watch their house go up in value, right? They watch their investment accounts go up in value. So, they had their job, they had, money that they were making as for their living, but then when they're looking at their net worth statement, it's really easy to conflate sort of what your net worth is with sort of earnings that I've made, right? So you feel wealthier, you feel richer. If your house appreciated by $100,000 or $200,000, it might feel like, hey, I've got extra money. I can go out and spend on a car. I can go out and spend on some large purchase. And I think the question really becomes, is that sustainable? Because if we see interest rates go up, which we have, if they continue to go up, housing prices start coming down, are consumers going to continue to be as willing to spend as they have been? So definitely an area that we have to watch.
Keep an eye on.
Yeah. And yeah, I think the Fed has made it pretty clear that they want to slow down housing.
Yes.
That's kind of one of those areas that they were very specific about with raising interest rates. So we'll have to see how that plays out with regards to the consumer.
Yes.
Right. So what happens next? When will the volatility end?
I think the volatility ends when the Fed feels comfortable and stops raising rates.
Yeah.
And at least when they start keeping them steady and there's encouragement in the market that they're not going to continue to raise rates. Not that they're going to be lowered anytime soon, but at least they're going to stay steady. And then that, I think, will be the key when people will know.
Yeah, and I agree. I think when the Fed can at least give us enough insight as to when that's going to stop. So it's not that the volatility stops the minute they stop, but when they say, hey, next time, that's it, right? We're going to this level and that's it. Then the market can price in sort of where they expect this to go, which, I mean, they've done an okay job, I think, of sort of leaving that pretty open, kind of explaining to us what they're doing. They've been very transparent about kind of what their plan is. But, again, we as the market, you, me, a million other people are trying to, figure out what should this be worth if these variables are changing. And there's quite a few variables, right?
There are a lot of variables. And the Fed has really not done this before. I mean, the way monetary policy is now, I'm sure the Fed is having these same long debates on their end, trying to figure out where that number is.
Yeah. So, you bring up a good point, and one of the things we were talking about, before was this sort of money supply, and kind of what that looked like, just the amount of money that got pumped into the system from COVID, and even when you compare that to 2008, well, really 2009 and 10, when again we were trying to recover. It seemed
When the
like,
Fed stepped in and told banks, you now have to hold more reserves.
yeah,
And that brought more money in. And then with COVID, they pumped a lot of money in to make sure we stayed alive during COVID. So I think the money supply went from less than a trillion to almost 10
yeah,
trillion of money that's in the economy now that wasn't there
and
in the
that
last, what was that, 10 years? 10 years, that's got to be taken care of. And I think that's part of the problem.
and it, yeah, I mean
That's what's causing part of the inflation.
and so how does that money come back out of the system? And I'm sure the Fed's trying to answer that question as well. So we're looking at it from the perspective of what investments can or should be made uh, based on what things are right now. When we know that there's going to be this need to take money out of the system, and we don't exactly know how the Fed's going to do that, but we've got to be able to watch that and then be prepared to make investments or change what
Right.
we're looking at.
So where does that leave us with our clients and our investments and what we're looking at?
And if you look at kind of historically, and we're talking over like a long term, like a long range, S&P trading at 15, 16 times earnings on average. And really, when we're saying earnings, if you're looking at, all of the companies in the S&P 500 and, kind of taking those earnings and coming up with your multiple of what the price is to those earnings, if you, instead of looking at it over 100 years, if you kind of shorten that down and look at like the Shiller ratio, which is really just looking at over the last 10 years, you get into a little bit more of, the market over the last 10 years is traded at about 20, 25, 26 times. And that's where we're at now. I think we're at, 27. So we're fairly valued during times when the market, is sort of irrationally exuberant, right? We've seen the market trade at 35, 40 times earnings during times when people are pretty fearful. The market trades at a lower multiple, maybe in the 15 time. So, again, looking at those multiples, yeah, I think we're fairly valued, which, that doesn't mean that it can't go down, and it doesn't mean it can't go up, but I think we probably trade in this band
Right.
for a while. We'll have some good days, some bad days.
Right. And one of the reasons I think that we're not terribly worried about the short term is we'd like to, if you look at this graph that we've got, you can see that we're not in unusual times. We've got a war going on. We've got the high inflation. Europe is being pinched. And I think when we look at all the crises that happened in the last 50 years, we always come back from those.
Yeah.
And so we're looking at these things historically, along with what is the best place for us to be now.
Yeah, and one, you had pointed this out to me, was kind of looking at when there's a correction and then the subsequent year. So,
yes.
So generally, if you have a pullback, and I don't know if again, we can have the chart up on the screen, but ultimately we tend to see, pretty quickly after a down year, a pretty good recovery. And even if it takes a couple of years to fully recover, I mean, that generally happens, pretty quickly.
Right. Yeah. According to the statistics, over the last 40 years, after a down market, it's, over double digits, it's come back. We've been up almost 25% in year one and 37% in year two. There's only been 2 or 3 times where that's not happened. It's taken a little longer, but it's always come back.
Yeah. Certainly, we want to try to identify areas in the market that are maybe worth being careful or not being overweight in or maybe underweight. And then we want to identify areas to maybe be overweight. So we want to stay fully invested, or we don't want to try to time the market.
No.
But there are some sectors or areas that we can adjust and be a little bit tactical about, why we're looking at some areas.
Right. So when we make movements, these are the kinds of discussions that we have before we make any changes to the portfolios. Is how are we going to handle what's happening now? Where do we think we're going to go? And I think now some of the areas we like are dividend players.
Yeah. So one of the things about kind of this value versus growth, right? And a growth company being, Apple or somebody who's just constantly coming out with new products and reinventing this product, so they just keep selling more. And so every year they sell more than they sold the year before. And that growth story attracts investment. And then on the other end of the spectrum is that value company that they do what they do. They do it well enough that they just continue.
Like your Coca-Colas.
Yeah, they just continue plugging away and just selling the same amount of stuff. And they're not reinventing the wheel. No one's coming out with the next new breakfast cereal. They just continue to make whatever it is they make. And that value company, since they're not attracting investors by way of, hey, look at this next new gadget that we've come up with, since it's just sort of, hey, we just keep doing what we're doing, the way they attract investors is by paying a dividend. And, especially when you have interest rates going up and treasuries now paying, a pretty good yield, if you're a dividend payer, in the past, you haven't really had to compete with that. And so now you've got investors that are deciding, do I want to own a treasury that pays, 4% for a 2-year or it's pretty flat. Right. The yield curve is pretty flat, but whether you're looking at like a 4, 5, 6 year, time frame, you could be getting, 3.5%, 4%. Why would you own a dividend payer unless they're willing to raise their dividend? So I think, just like I said before, stock prices follow earnings. If these dividends come up, that's going to, generate interest in that stock, and again, kind of gives some interest in investing there. What was really interesting is over the last 6 months, even over the last this year to date window, value and dividend pairs have really done well. And when I say well, we all lost money, right? Everybody went down, right? But they didn't go down as much as the growth side, because again, there was that dividend.
Right,
attached.
People were still getting money even when it goes down. The dividend payers still continue to pay their dividend.
Yeah, so that's an area that we're looking at. I mentioned fixed income.
Yes.
It's
finally paying interest.
Yeah, it's finally. It's been 10 years, right? I think there's a lot of folks from a portfolio standpoint that, for the last several years at least, we haven't been able to get the income that we wanted from fixed income. And now we can kind of rotate into more fixed income to meet some of those, income needs that they might have as an investor, in retirement, something like that. So is that an area that
yes, I think we're definitely, now that we're starting to get some interest rates, it's definitely a place that we're looking to go to. Yeah. And there's a lot of different areas within the fixed income that we can put people in depending on your portfolio and risk.
Yeah, and I, generally, bonds that are trading sort of above par because interest rates went down while, they were, like now we're actually seeing, some bonds trading sort of under value. And so there's a real return opportunity. There's the yield you're getting, but then the closer you get to that bond maturing, you're actually, so if you're buying a bond for 10 cents on the dollar, 90 cents on the dollar, a 10-cent discount, as you get closer to maturity, you're making back that percentage. So that's actually, I'm pretty excited about fixed income for that reason, not just the income, but the capital appreciation that you can get from those underlying
from the
bonds.
ones that were issued with lower interest rates that are now coming due.
What are your thoughts on tech? Because we've gone back and forth on this.
We have gone back and forth on tech. I am bullish on tech.
Okay.
I think as a country, We're very innovative. We figure out solutions to problems. We have amazingly free thinkers here. And I think as problems arise, we figure out a way to do it. We needed to get electric cars. The market is now being full of electric cars. So I think as we see these problems, we're going to come up with solutions. And no matter whether it's in a payroll system or a car or how to get more produce out of the limited amount of water and space we have, we're going to figure out a way. And there's technology in everything. So
and I agree with you. I do, but my hesitancy really has to do with how do we value that? Because you mentioned electric cars, and again, this is not a recommendation about a particular stock. This is just to illustrate a point. But Tesla is, by market cap, the most valuable car company on the planet, and they're going to sell 2 million cars this year, which is great. But does it really warrant them being larger than Ford and GM and Honda and Volkswagen combined?
That's a good question, because Ford will have more electric cars on the road than Tesla.
So again, how do we value? Yes, I agree. Technology is going to answer or solve the problems that we have, and there's an opportunity to profit from solving a problem. But how do we value that? And how do we not get carried away with thinking that, oh, this is going to be the best thing since sliced bread, when the barrier to entry for someone else to come in and do what you're doing and replicate your technology is not that strong, right? I mean, it's...
Right, and I think that's why when we look at where we're going to put our technology investment, we have to be very critical and really take a look at where that funds is going to go. And where does it make the most sense? Because I do think it needs to be a part of the portfolio, and it is in different areas. But I think if we're going to focus on that, we have to be very tactical.
Okay, so U.S. tech or international? Do we look domestically for that, or?
I think we look domestically for that. I think when we see what's happening, around the world, the people who are creating the technology, it's happening in the U.S. whether or not they're U.S. citizens, but
people want to come to the U.S. They want to work for U.S. companies.
They want to work for U.S. companies. We're seeing that other countries are becoming, they don't give the freedoms that America does, and I think that just lets people who want to be creative and come up with these new ideas are going to come here, and that's why we are focusing more, I think, on the U.S. economy coming out of this before Europe with their troubles and Asia with their troubles.
And from a technology standpoint, the U.S. obviously offers more patent protection. So that barrier to entry for someone else to come in and do what you're doing is a little bit more difficult in the U.S. for someone to just kind of copy what has already been done, right? So that does protect U.S. companies. And if we're able to make a technology here and then export it to the world, we benefit from a global rise in sort of middle-class consumers, but it's still U.S. technology, U.S. companies that are able to sell to that.
Yes. And I think we've talked a lot about what's happening in Europe. They're getting a squeeze because of the war with Ukraine.
Energy prices
are really skyrocketing in Europe. They're going to have their own battles and inflation going on. Britain has some unease. Today we just found out the Prime Minister has resigned.
Keep in mind we're recording this, so that might be old news by the time.
Yes, this is October 20th. But things here are stable, and so that's why we're focusing on companies here. For the most part, we still think there are some nice European companies out there, some big players in the system that aren't going to be affected, because they're stable. They're staples, and they're things that import to the U.S. We buy them, so we try to be tactical. But right now, I think we're focusing more on the U.S.
And so, you bring up a good point about internationally, and as an asset class, emerging markets has been an area that, again, I'm interested in that emerging market consumer. But can we get to that consumer via a U.S. or a global company that happens to be domiciled in the U.S., right? So with the emerging markets, obviously there is some tension. Russia, China, those. While we do sell a lot of stuff to China and we buy a lot of stuff from China, that we aren't necessarily on the best of terms. So from an investment standpoint, what are we looking at from the emerging markets?
I think it's one of those we want to keep a toe in because right now it is down. It's a good place. We have some potential there, but I think, again, we have to be strategic about it. I think we need to limit our China exposure. I think we have to, obviously, Russia's out.
Yeah.
And so I think we're just going to have to, look at the more stable emerging market countries.
Yeah, and like I said, that U.S. company who sells their product into these markets. And I know I kind of, my comments on Tesla, they are selling a lot of cars in China. So that is another example of a U.S. company that is able to take advantage of this sort of emerging market middle class consumer.
Yes, I mean they want American products, and that bodes well for us.
Yeah. So another area that I like to look at is kind of small cap companies, and I don't know that I'm ready to say, hey, let's really dive into that. But when you think about small caps as a sector, and we're talking companies that are, 5 billion in market cap or lower, they tend to lead out of recession. So even though we're not calling this a recession, that's going to be one of those leading indicators that kind of tells us like, hey, the market has absorbed the higher interest rate, and now these small cap companies are starting to be able to sort of respond. And so when you think about a small cap company, they're completely dependent on borrowing money, which over the last 10 years, that has been very easy for them to do. So they were able to grow significantly just because they had easy access to capital. Now they've got to, kind of rework some of their business models, because it may very well be that some of these companies are only able to exist because they had easy access to credit. Like their business model is entirely dependent on borrowing money and levered growth. Yeah. So that's an area that I'm looking at, and I haven't necessarily seen it break out, but that's what I'm watching for, is to see when these small cap companies are able to start, really responding with good earnings. Right. And then the stock prices will follow the earnings. So that's definitely on my mind. What else do you think is worth taking a look at?
I think the biggest answer is we always want to be allocated, because although we have ideas of where we think things are going to go, we never know if we're correct.
Yeah.
So, and if you look historically, rarely has there ever been one sector that has done the best 2 years in a row.
Yeah.
And sometimes this best sector surprises everybody.
Yeah.
I mean, if you would have looked, a year ago for energy, you wouldn't have thought this, nobody knew the war was happening and energy was going to be the big winner. So we want to make sure that if we don't anticipate what the next winner is, we want to make sure we've got our toe in it.
So one of the things that we've been working on this year is our investment policy statement, and making sure that we have good communication with clients about what we're invested in and why we're invested there, as well as the types of investments that we have. And so, with that investment policy statement, we're able to very clearly identify the time horizon of the client, the risk tolerance of the client, and then that can give us that investment objective. And now we can say, hey, you are a moderate or a more of a growth-focused investor. Now we can create that allocation that we're going to try to stay pretty close to that model, regardless of what the market's doing.
Right.
And so, unless there's some radical change to your time horizon, or unless there's some radical change to your risk tolerance, we wouldn't necessarily make big shifts in what you're invested in just because of what's happening in the market.
Correct.
And so, I think that's an area that we definitely need to make sure, people understand why they're invested, where they're invested, and we do kind of keep our toe in the water on some of these asset classes.
I think that's a great thing that you said, Dave. So when we get a portfolio together and we figure out where they're going to be allocated, what happens is, say if we have 10% to a certain sector and that sector goes up and becomes 15% of the portfolio is no longer what we had originally wanted it to be. So we sell the one that did really well and sell high, and then we buy what has become less in the portfolio. So we get back to the original allocation model that we want.
Yeah, and I think that's a challenge sometimes. People might not understand, why are we buying this? It didn't do well. And we have to make sure that everybody understands we're doing it because we want to sell high, we want to buy low, and this is that rebalancing opportunity where, again, we can take advantage of something that outperformed.
For instance, if we look back at what we call the dot bomb in the 2000s, tech was going up 100, 200, 300% and was overweighting the portfolios. And so if you didn't sell and buy what was lagging behind, then when it completely crashed, you lost all your money instead of losing that little 10% portion that was supposed to be in tech, or whatever that portion was. So that's one of the ways that we use our investment policy, is to make sure we're allocating to what the client wants and where the client should be.
So we kind of talked about this one before, but inflation. Where does it go? What?
Oh, that is really a good question. I don't know. I think we're probably, and this is just my opinion, I think we're probably in for another couple of rate hikes. Because from everything that I'm seeing now, the economy is doing well. People are still spending. And so I think the Fed is going to try and kind of squash the inflation, and so they're going to raise rates.
Okay.
What do you think?
Yeah, I definitely think that I think that inflation is here to stay. We've gone 40 years without having to deal with inflation. I'm 42, so I haven't seen it in my lifetime. I remember as a kid, my great grandma, when I was a baby, had bought like a 10-year savings bond or CD or something, and so it was like a 14% bond, and so by the time it matured, when I was like 10 or so years old, here I had this big chunk of change, and you couldn't reinvest that at a good interest rate. But for the most part, I personally haven't really experienced. I've just sort of heard about it, and I think that there's a lot of people out there that are not fully understanding what this means. We're going to have to make some pretty radical changes from a consumption standpoint. And, again, we do have the ability to substitute. So, if you liked a certain brand or if you liked a certain thing, you might be looking for a less expensive version. When it comes to like food, we've seen sort of this really tricky packaging, like they're keeping the price the same, but they're reducing the size of the package, right? So we're still experiencing inflation.
There's a lot more air in the potato chip bag.
Exactly. But I think that brings up another, interesting kind of topic there with regards to food. And, we just saw the news, the merger between Albertsons and Kroger. Again, this is not an investment, recommendation. It's just using that as an example. But, here are companies that they're competing against each other for pricing power. And they can go to war with each other over raising prices. And then, people that shopped at one store would, go to the other. Or I think maybe they've kind of realized, rather than go to war with each other, they need to just join forces so that they can have a more coordinated, discipline to their price increases. So, obviously that's a big merge, and it has to be reviewed by, regulators have to look at that. But I think that's the writing on the wall, that
Consolidation.
Yeah, prices are going to go up. As consumers, we're going to be pinched. So I think that we talked about earnings. That price increase, the pricing power that these companies then have, will actually cause their earnings to go up. And if we're looking at stock prices following earnings, as much as inflation as a consumer is not favorable, inflation as an investor in the long run does actually pan out. So if you've got, a company has, what do they make, widgets, whatever, as an example, if you got a $10 input cost and you sell your product for 15, that's a 50% margin. I'm using just basic math because I can't, I can't do a lot of calculus in my head. But so if you've got a 50% margin, your input cost is $10, you sell your product for 15. If your input costs go up to $12, your margin got squeezed. Now you're only making $3 profit, right? You're making a 25% margin. So if you want to get your margin back up to 50%, you have to now sell your product for $18. Well, when you do the math, that's now a $6 revenue. So if before your earnings were $5, because your input cost for 10, you sold it for 15.
Right.
Now
Keeping
maintaining that
50%.
margin, you're going to have more earnings. And I think, that is another example of why inflation is permanent. It doesn't go back. And, again, as a consumer, not good. As a investor,
Shareholder.
In the long run, so immediately, right, we're going to see that volatility. But, if we stay with these things, 3 years, 5 years from now, we definitely see.
Should be rewarded.
Yeah, we should be. So to wrap it all up, this is a conversation that we're having pretty frequently. And this was a great opportunity to kind of show people what we go through, what kind of conversations we're having behind the scenes. Today we talked about what happened in the third quarter. We talked about sort of the interest rate hikes, the reasons why, the inflation, the market, the volatility, as far as, we've seen the market, go down quite a bit, start to come back. And, a lot of that, we're still watching, it's still developing. We've got some areas that we are looking at, like value stocks, dividend paying stocks, some fixed income opportunities. Areas that we're still, technology might still be kind of a point of, but again, there's really some good opportunities there. And so again, this is a conversation that we're having all the time, and we want to be able to bring that to our clients and anyone who's interested in watching.
And maybe just getting a short version of what's going on in the market or what just happened.
Yeah.
So we're gonna let us know if you liked this or found it interesting or had any questions. We would love to know your thoughts on this. We're thinking maybe we'll do another one next quarter.
Yeah.
Or if something comes up and we feel we need to maybe put a little video out there about what's happening, let us know.
info@lsinvestmentmanagement.com. You can reach us there. The La Mesa office, the phone number there
is 619-303-0080, and the Vista office
760-231-1103. And again, if our clients, you have our email addresses, but if you happen to be getting this video from somebody, or if you haven't reached out to us before, info@lsinvestmentmanagement.com is where you can reach us.
And this was our first one, so please forgive our flubs and mistakes and nervousness. Thank you.
I think we nailed it.
I think we nailed it.
Yeah, I think we nailed it. All right, thanks. Cheers.
Cheers. All right, we'll cut all that.
Yeah, well, whatever.